So today we're going to just be going over the basic terms and definitions that we use in the market, right? Basically the language of the market. Usually I would just give this as a prerequisite, but I know a lot of people lazy and they don't do their homework. So I'm gonna do it right now, right? So basically there are certain words that might be new to you and certain terms that we use in the market in order for us to communicate to the market or just understand, right? Basically, we already know the forex market is the value of one currency pinned against another, right? Basically, we trade the exchange rate. So as that value moves up and down, as you can see in this chart, most people are accustomed to a line chart, right? As that value moves up and down, we basically place trades in whichever direction we think it might go in order to profit from it, right? So one of the first and most important term we use in the market, and please take notes, right? Because I'm not going to write out everything, is the term, you might see this a lot, called pips, right? Basically, pips simply means a percentage of a point. Pips is the word we use to measure the distance from one price to another, right? So basically, anytime you place a trade, you would have your target in pips or your risk in pips. Most people would say points, but in the forex market, the term we use is pips, right? So for example, the distance from, let's say, $1.11 on this Euro USD chart, meaning €1 is equal to $1.11 over here. This red number, right? So let's say $1.12. So the distance from $1.11 and $1.12 would be 100 pips, right? So meaning 1 cent difference in the forex market is equivalent to 100 pips, right? Now, if you were to place a trade at this price, $1.11, or $1 per pip, you enter how much you want one pip to worth. So if you enter a trade down here for $1 per pip and it goes up 1 cent, which is equal to 100 pips, that would be $100 profit, right? So that is what the word pips mean in a nutshell. And we'll go deeper into it later on, as in how to calculate your pips, right? So you just need to know the distance, the difference in the price, how much is equivalent in pips. And this was like a very simple example. $1.11 on Euro USD to $1.12 on Euro USD is 100 pips, right? Most of the time we'll be calculating it from the fourth or the third or fourth decimal point, right? But this was just from the second decimal point. So, well, I could just do this since we're on this topic. So I guess the second decimal point would be 100 pips. The third would be like in the tens, and the fourth would be the ones, if we could call it that, right? The second term would be pairs, right? Pairs, meaning currency pairs, right? On the side here, you would see a list of currency pairs that you would have to memorize. They're easy to memorize, right? It simply means the value of one currency pinned against another. For example, we have Australian AUD, USD, that's Australian dollar versus the US dollar. You can see it in the little pop-up here, right? NZD CAD would be New Zealand dollar versus the Canadian dollar. Euro JPY, EUR JPY would be Euro versus the Japanese yen, right? All of these pairs, the first currency in the pair is usually the base currency, meaning one of that currency equals to the other currency. So meaning 1 Australian dollar equals to 0.68 cents in US dollars, right? For Australian over here. And 1 New Zealand dollar is 0.86 cents in Canadian dollars, right? And over here we would have 1 US dollar would be equal to 110 Japanese yen, right? Now the value is never the same. It goes up and down throughout the day, right? So the next term we would use would be markets, right? So that would be like the forex market, the stock market. The forex market is with forex, foreign currency pairs. You have the commodities market, which is a different market you could trade. You have the futures market and the indices market and the stock markets. All other different trading markets we have access to, and we will be trading because we don't just trade forex alone, right? Basically, we could trade anything that has a value that moves, right? So we could trade oil, we could trade gold, we could trade cryptocurrency as well, right? So the next term would be risk, right? And all these words are just prerequisites that you would need to know when you're trading, right? So risk is basically what you're willing to risk, like what you're willing to lose in the market. Because for every trade we place, we have to risk money, right? So usually I would say risk 5% or less. So if you have $1,000 in your account and you place in a trade, you would have to calculate your risk, right? And to calculate your risk, first you have to figure out how many pips are you risking. If you're risking 10 pips, right? Then you know that the trade you enter have to equivalent to $50 risk. So you have to make 10 pips worth $50, right? So you would probably just make you do that calculation, right? So anyways, risk is pretty much self-explanatory, right? And then we have probability, right? Probability meaning when we place trades, it's more of a game of probabilities, right? So you want to find several reasons why this currency pair is going to go in that direction, meaning you want to place high probability trades. So you want the odds in your favor, right? Because if you just look at the market and you press buy or sell and you don't know why you're placing a trade, then the probability is probably not in your favor. So we do research to figure out where's the highest probability direction the market could go, right? So next we have broker, right? So a broker is basically like a company that gives you access to the market, right? Meaning you sign up with that broker verifies your information that you're actually a real person, and then you deposit your money to the broker, and then the broker, with that broker now, you could create a trading account, and they would give you the login information, right? So once you deposit the money to the broker puts you then put it in your trading account through the broker, and once it's in your trading account, you'll be able to sign into the app on your phone and place the trades. Later on, we will go through making a trading account, and I would show you how to use the website and the brokers that I would recommend, right? So, and also there are two types of brokers, right? There are brokers called A book brokers and B book brokers, right? Meaning that A book brokers, I'm not sure if it's A book or B book, but one of them gives you direct access to the market, meaning that when you place a trade, the trade actually goes onto the market. And when you close the trade, you receive the money, right? And there are B book brokers, meaning when you place the trade, the brokers don't actually put the trade on the market, right? So, for example, with A book, if you lose your money, you lose your money in the market. And with B book broker, because they don't actually put your money in the market, they just keep the money because they're assuming that you're going to lose. You're a new trader, you're going to lose. So with the account, even though it's a real account, it's like a demo account because they're expecting you to lose. So they just keep the money, right? However, if you actually win, then they have to pay you out of their pocket, right? Okay, let's go on to the next one. Okay, so in Forex, we have the term called long, right? And short. Going long and going short is very simple. Going long simply means that you're buying, meaning that you're expecting the value of that currency pair to go up, right, in price. So if you go long at $1.12.1, then you're expecting the price to go up. If you go short at this price, then you're expecting the price to go down, right? Simple. Spread is basically when you look at, well, when you open up a trading account, you would see the market, the price of the market, right? So meaning this this green line you see on my screen here, that is the current price of the market, $1.10.9, right? But when you open a trading account, you're gonna see two lines, right? Basically two prices. You might have $1.10.9, and then you might have $1 and let's say 11 cents, for example, right? So you would have two lines like this, moving simultaneously, right? Now the space in the middle is called the spread. The difference in that price would probably be like 1 pip, and the spread is basically what the broker gets every time you place a trade. meaning whatever trade you place, the broker would probably collect like 1 pip worth of your trade, right? So then we have leverage, right? Leverage is kind of self-explanatory, meaning whenever we're trading, the money we put in our trading accounts, we use maybe 500 times that amount, right? Because really and truly, in order to actually profit from the market, you would need at least 10,000, maybe $20,000 to place a trade for it to worth anything, for you to actually make any money off of it. But with leverage, we are able to access the market and place trade and make profits with far less money than is actually needed, right? So usually when you sign up to a broker, they would ask you what leverage you want, and you would say 1 to 500, for example. 1 to 500, right? So this simply means that whatever money you put in your account, you have 500 times that amount to use, right? So if you want to place a trade for, let's say $1 a pip, with a leverage of 1 to 500, the broker would say, okay, we need to secure at least $20 out of your account to keep this trade open, because the broker has to secure money to keep your trade open, right? However, if your leverage was 1 to 10, right? Instead of that being $20 to keep the trade open, the same trade for $1 a point, it would probably be like $2,000 to keep the trade open, you know? And to secure $2,000 to keep a small trade open for like $1 a point might seem ridiculous, you know? So that's why we use leverage, right? So like I said, all of these are just terms you need to know, right? We're not going to go over them again, but memorize them and you can do your own little research, right? Then we have stop loss, right? Stop loss is simply the price you would like to get out at, right? It's simply a price at which you decide this is how much you're willing to risk, and if it hits your stop loss, you're out, right? So for example, let's say I place that trade here, right? Now the black line in the middle would be the entry price, $1.12, and this red line at the bottom would be your stop loss, right? So the stop loss, let's say the stop loss is $1.12 and 381, right? Now, if you're risking $10 on this trade and the value of the entry price, which would be here, down to the stop loss, would be equivalent to $10. This would mean that once the market hits this line, you lose $10. Once it stays above the price you entered at, you're not losing any money. But once it goes down into the red, you'll be losing money. And then once it hit the bottom, which would be a stop loss, you're out with $10. Your stop loss is simply your exit from the market, right? You accepting that you've lost and you're exiting at this price. Now, if you didn't have a stop loss and the market kept falling, you would just keep losing money, right? However, the stop loss is just an exit point. And then you have your take profit, right? Which would be the top of this green line here. Your take profit is simply the price you would like to get out at in profit. Meaning if your target is, let's say your target, the distance from the entry price to the top here worth about $20, right? And that's your target. Once the market hits your take profit, the trade would automatically close and you would have $20 added to your trading balance, right? Now you don't must have take profit. If you leave it open, then you would just keep making money until you decide to manually close the trade yourself. However, the take profit, like the stop loss, is just an exit from the market, right? Now we have limits orders, right? Let me type this out. Limit orders, right? So basically, a limit order is how there are different ways to enter the market, right? So limit orders are just the different ways you can enter the market, right? So for example, the first type of entry you can enter the market is called market execution, right? This simply means that you're entering at the current price, right? So for example, down here, this is the current price of the market, $1.20, right? So if you enter a trade to go long, to buy, you'll be entering at this exact price, right? Right in the middle where the black line is, right? You'll have the target, you see the top mark target, and then you have the stop loss, right? At the bottom here. So just this is an example of a measuring tool too. So you see how I'm moving this up and down, and the numbers changing. The number in the middle is the pips, right? So if I bring it up, I can bring it up to 100 pips, right? So here our target is 100 pips. And however, our risk would be 34 pips. Just an example, right? So entering at the current market price is a market execution. Then we have what we call a buy limit, right? We have a buy limit, so limit, I have this stop, and I have buys, right? So these are all the other ways you can enter the market, right? And I'll send you some PDFs on this, right? So a buy limit is simply you setting up a buy trade. However, the trade has not been activated yet, right? Because the market has not gotten to the price that you want it to activate. When it does, it will activate by itself, right? So usually a buy limit would look like this. The entry would be under the current market price and you expecting the market to come down, right? Touch the entry would always be the black line in the middle. So once it gets to that price, it automatically enters and you'd expect it to bounce back up, right? And I'll send you a PDF on this, which should explain it much better, right? A sell limit is the exact opposite, meaning that you're expecting to sell, right? And the market has not gotten to the price you want to sell at yet. So your entry, obviously the black line in the middle here. You're expecting the market to come up, activate your sell, right? And drop, right? And we're going to go over this a little later on again, right? And a sell stop and buy stop is completely different. You see, in these first two examples, you're expecting the market to reverse the bonks, right? On a sell stop or buy stop, you're just expecting it to continue going down, right? Or up. So, for example, let's say we're expecting this price to keep going down, right? And we don't want to enter the prices at right now. So we set what we call a sell stop, right? So once the market goes down and it hits this black line right here in the middle, the trade will automatically enter. And it'll be a sell. So your target would be down here. You're just expecting the market to continue going down, right? And for buy stop is the exact opposite. You think the market is gonna go up, so you want to buy it at a higher price. So you just set up your buy stop. Once you set it up, if the market going up, it would automatically enter the trade for you once it touches this price and continue going up to your target, right? Let's see. Moment. Orders. All right. Forex. So these are like this is a picture with right? So here we have buy stop, order placed above price, and price keep going, right? The blue line would be your entry. So stop, order placed below the price, price keep going, right? Buy limit, order placed below the price, and then price goes up, so it bonks off the level you want to enter at. And sell limit, order placed above the price, and then it goes down, right? So I don't expect you to watch this video once. I expect you to make notes and go back and review it, right? Let's see what else I have here. So next I have charts. Charts, right? So basically, we do technical analysis. So we look at chart. Technical analysis means that we look at a chart and we analyze the historic data because the market tends to repeat itself, and we look for a pattern that we see repeats itself, and then we place we make our decisions based off of that, right? So let's go through the different types of charts we have, right? So in the forex market, mostly you're accustomed with a line chart, right? Basically in this chart, you have the date at the bottom, the price at the side, you have the currency pair at the top left, and you have the time frame. 240 means 240 minutes or 4-hour chart. Right, we'll go into that next. So you have the line chart, which we use sometimes. It's just the line. We have the bar chart, which we do not use. We have the candlestick chart. We have this chart here. I'm not even sure what it is. And then we have the area charts, and then okay, well, as you can see, there's a lot of different charts, right? But the main chart we use is the candlestick chart, right? Because the candlestick chart gives us enough information to make our decision, right? Personally, it's the only chart we use from 90% of the time, and it's the best chart. So Um, I have to teach you how to read these candles, right? But it'll probably be in another lesson. Okay. So, and then aside from the charts, um, we analyze the markets through looking at the different what's happening on the different time frames, right? So in the forex market, we go through different time frames to make a decision, right? Meaning, let's go on the 1 hour time frame. So this is the 1 hour time frame, right? What does that mean? That means that each candle on this chart represents 1 hour of movement, right? So this is 1 hour, 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 right? So for example, we know that on this candlestick, the market moved down 13 pips for this hour right here, right? And then this one. And just for example, we could see that we have what 7 candlesticks over here, right? So this is basically 7 hours of movement, right? Up and down, right? So if we measure this with this measuring tool, we see max 7 bars, 7 hours. Just looking at this, we could see that the market didn't go nowhere for 7 hours, right? Basically, the candles went sideways for 7 hours. So let's just give it a measure. Let's measure all these candles from here down to down here, right? So basically, this is 51 candles, right? So it took the market 51 hours to move from $1.11 over here down to $1.10, which is 4 days, right? So then in 4 days, the market moved down 91 pips. So if you had placed a trade up here for $1, and in 4 days, you probably make $91, right? So anyways, so this is the 1 hour chart. The 4 hour chart is the exact same thing, except each candle represents 4 hours of movement, right? So this one green candle you see here on the 4 hour chart is one candle, but on the 1 hour chart it's 4 candles, right? So look like a lot more than 4, but every candle is on the one is a 4 hour chart, so on the 1 hour chart it will be 4 candles, right? On the daily, this is how I change switch time frames up here. I'm gonna show you how to use this tool that I use here. So on the daily chart, each candle represents 1 day of movement, right? So in one day, the price moved from the top here to the bottom, and in each daily candle, if we were to break this daily candle down, we highlight it, there would be 24 1 hour candles in the daily candle, because we know obviously there are 24 hours in one day, right? And then there's gonna be a couple 4 hour candles in the daily candle, right? And then we have the weekly, right, time frame. So one candle represents 1 week of movement, so there'll be 7 daily candles in that one weekly candle, right? And so on for the monthly, right? Like in forex, depending on your time, your availability, how often you want to trade, you pick a time frame, right? So if you're a busy person, then you'll probably be trading the daily chart, because the market moves slow on the daily chart, right? Because it takes 1 day for a candle to form. But if you like fast pace and you want to trade beating out other trades in a few minutes, you look for patterns on the lower time frame. So you have down to the 1 minute, 3 minutes, 5 minutes, 15 minutes, 45 minutes. If we were to go on the 15 minutes, you would see a lot more candles, right? So for example, we're on the 4 hour. Let's go on the 4 hour, right? I'm going to highlight this area on the 4 hour chart, right? Now on the 4 hour chart, you're only going to see 1, 2, 3, 4, 5, 6, 7 candles, right? But the lower you go down in the time frame, the more candles you're going to see, right? So we're on the 1 hour chart now. You can see a lot more candles. If we go on the 15 minutes for the highlighted area, you can see a lot more candles, right? You can even go down to the 5, right? So it all depends on how much you want to trade, how often you want to trade, how fast you want to trade, and you select the time frame. And obviously you're going to learn all of that. Right now we're just going over the terms and the definitions, So do we have any questions? Any questions? Please hit me with at least one. In the chat or just unmute your mic. I'm waiting.
Real quick, can you repeat the definition of leverage?
Leverage, okay. All right, let's see. Let me see. We have a more simple explanation for Google. Okay, so leverage of forex is the ratio of the trader's fund to the size of the broker's credit. In other words, leverage is a borrowed capital to increase potential returns. So forex leverage is a way for traders to trade much bigger volumes than he would only using a limited amount of trading capital, all right? And like if you just if you want to do like a extra research on the stuff that I explained, you just Google it. Let's see. Thought they had like a little cute little picture here. Anyways, let's go to images. So on this image here, we have 2-to-1 leverage. So if you have $1,000 in your trading account, then you have $2,000 worth of purchasing power, right? Meaning you can use $2,000 to trade to make money. And then when you get to 200 to 1 or 1 to 2, like I call it, and you have $1,000 in your trading account, then you have $200,000 to use to trade, right? Now, the reason why you need all this money to trade is because you're actually buying a currency, right? and that currency is only moving a few cents, right? Maybe 1 cent, maybe a tenth of a cent. Now, in order for you to actually profit off that small movement, right, you need to have bought a lot of that currency. So even though you have $1,000 and you place a trade, the broker is going to place the trade for hundreds of thousands of dollars, right? But that won't affect your account because the price movement is so small that the profit is so small that it's just a couple $100 at first. Even if you lose money, right? Because the market moving a tenth of a cent, it's just a couple hundred. So it's not that much, right? So really and truly, when the broker borrows you that money to place the trade, right? Let's say your leverage is 1 to 200, and you have $1,000 invested, and your purchasing power is 200,000, right? When the broker borrows you that $200,000 to place that trade, the broker isn't worried because their money isn't at risk, right? If you lose that trade and you lose a couple dollars or a couple $100, the money that they borrowed you is not affected because the money that is lost comes out from your $1,000, right? It doesn't come out from their money. It never comes out from their money. So you never have to worry about losing their money. You only have to worry about losing your money. Because if you lose out of your money. And if you win, the money goes to you. All right? I hope that answers your question. Okay, so um, that's all I had for today. I'll send you a screenshot of all the terms are defined in the chat. So if there's anyone you didn't really understand, you could just Google it. All right. So we're gonna cut it off right here. Thanks for hopping on, and I'm gonna see you guys on the next session.